In this video, I want to share some tips for swing trading in volatile markets. Right now, the markets are going pretty crazy, and I thought I'd share some of my best practices to prepare for this environment. So first, we're going to look at what is volatility in the first place and how can you define it. Then we'll talk about being practical and realistic in changing market types, some ideas on why you should reduce your position sizes, as well as how you can adjust your expectations and why profit targets might be worth using. So first I want to start with identifying what volatile market conditions look like, because if you don't know the environment you're trading in, how can you adapt? So typically I like to classify markets as bullish or bearish or sideways, and volatile or calm. Now, for the first part of this, bullish or bearish, I like to look at moving averages on one of the major indexes. So in this case, the SPY ETF works quite well. I've just pulled that up over on stockcharts.com, and you can see I have the 50, 220-day moving averages. And these are just configured down at the bottom of the chart here. Most charting platforms will have these. And here you can see that in the longer term, we're definitely in a downtrending market on this daily chart. Although we've bounced more recently and we may start to form a range, but the larger term trend, as shown by the longer moving averages, is down. Now, the other thing I mentioned was using ATR, which is a measure of volatility, average true range, to understand how much prices are moving. And again, on most charting platforms, this is an indicator that you can select. And what I've done here is, again, just selected the average true range over a number of different look-back windows, so a 5-day, a 20-day, and a 200-day. And these are plotted beneath the chart of the SPY ETF. And essentially what you can do is compare what the average true range is in the short term versus the long term. So you can see that on a long term view, a 200-day average, the average true range of the SPY is 4.5. But over the last 5 days, the average is actually closer to 15. So you can see the market is 3 times more volatile than it has been over the last, longer term, over the last 200 days. And again, the 20-day just provides a little bit more color, so you can see its volatility has increased, and while it's dropped a little bit slightly over the last trading month, it's been more than 2 times higher than it has been over the last year. So in the current environment, we've confirmed, okay, we're in a bit of a bearish downtrend here, albeit with a short-term bullish bounce, and the market on the short term is much more volatile, as shown by average true range, than it is over the long term. So that's step one, right, is identifying what are the conditions. And right now we can say, okay, these conditions are looking a little bearish, and they're looking quite volatile. So now what do we do? Next, I want to, just emphasize the importance of being practical, because in prices are moving farther and faster than they usually would. So depending on your trading system, the best move might actually be to sit aside, to go to cash. Sometimes trying to overdo things when markets are moving really fast, especially if you can't watch the market each day during the day, you might just find yourself getting chopped up, and a system that had worked in a calm, quiet, uptrending market may not be as effective in a wild, sideways, volatile downtrend. So, just kind of be practical and honest with yourself. Try to avoid that fear of missing out. There's a big expectations that when markets are volatile, there's lots of money to be made. That may be true for nimble day traders, but for longer term position traders or swing traders, that's not necessarily the case. So be practical. Now, the other thing I like to do when markets start moving quickly is to reduce my position size. So you saw previously that I'm using ATR, and I usually use a 20-week ATR to plan my stop losses. And the great thing about ATR is you can see it adjust to the volatility of the instrument you're looking at. So in the case of SPY and the 5-day ATR, back in November or December of 2019, the ATR was actually under 5, so the instrument was moving less than $5 a day. But now it's moving $15 a day. So if I had just used a fixed $5 stop loss, um, there's a much higher likelihood that in this volatile market, I'll just get stopped out because of the day-to-day noise, because the market's moving so fast. So that's why I like to use ATR, which naturally makes you have a wider stop loss during volatile markets. And then, if you're always risking the same amount per trade, 0.5% of your account, let's say, for example, the wider ATR means your stop is further from from your entry, and you end up having a smaller position size. Now, the good thing about these smaller position sizes is that when you are getting whipsawed in these small markets or in these fast moving markets, these smaller position size help you avoid significant drawdowns. And not only do they protect your trading capital, but this also helps you protect your emotional capital as well, because you're more likely to get whipsawed, and if you do, um, it doesn't sting as much. It's just a kind of like a paper cut instead of a big slice out of your account. Now, the next thing I want to say along the same lines is, you do really need to adjust your expectations and understand that when you do have volatile markets, you're going to get more whipsaws. You're going to enter a trade and immediately be stopped out. You're going to have more open profits that you're giving back. A trade will go in your favor, and then it will reverse really hard, and you'll give back all of your profits. You also have more losing trades. Things are just moving quickly. There's a lot more um, competition in the market. Your system's probably not going to work as well as it did in a calm, smooth uptrend. So if you haven't experienced this for yourself, it can be really frustrating. And when you get frustrated, you can end up making more and more mistakes. So, again, kind of going back to the be realistic, is the next part of that is adjust your expectations. Once you identify that, hey, we are in a bearish volatile market or even a bullish volatile market, just understand what that means. It means prices zigzagging back and forth, and your focus should maybe be more on preserving capital and putting small wins together rather than trying to catch the next big huge uptrend, just based on the market environment. Now, the last thing I want to kind of share a tip is consider using profit targets. So as a trend follower, I usually don't employ profit targets. I like to just use a trailing stop and let the trade go in my favor, and then I'll trail the stop higher each week or each day, depending on my time frame. But in volatile markets, it can be helpful to use profit targets. So for instance, going back to this SPY chart, if you were going to enter the trade, today at the close at 261 here, and let's say you had a 1 ATR stop, which is about $15 below price, so you'd have a stop loss level, around 246 here. Maybe you'd consider putting a profit target that's double your risk, so 2 ATR above, which would be about 290. And I think you could argue there's some resistance here, going back to these prior lows. Kind of this zone up here is maybe, if you do catch a breakout and ride the price up, maybe you consider taking profits once you've made double your risk. Again, as a trend follower, this isn't something I always do, but in volatile markets, you're probably more likely to retrace a bunch of that up move a little bit later. So profit targets can be a really helpful way to help you ring the bell. And you don't have to sell all of your position. You could use a profit target on half of it or a third of it. But again, going back to managing your expectations, it can help you stick to your system if you know that you have a mechanism to lock in some profits when you do get them. Of course, you still need to be mindful of your overall system expectancy, and you want to make more on your winners than you do on your losers. But in these kind of market environments, profit targets can help. And the other thing is, you don't need to automatically exit your trade when you hit a profit target. You could just tighten up your stop loss much closer, so that instead of having a $15 stop loss, maybe you move it to a $3 or $4 stop loss, so that if the stock or security or ETF keeps running in your favor, then you can continue to ride that wave higher. But if it reverses, you lock in some of your profits to make that winner count, because prices are moving far, so you can get some big wins in this environment. So I hope you found these tips helpful as you try to swing trade in the current market environment, which is quite volatile. Just as so, to recap, the first thing we want to do is identify market conditions. This is something I'm always doing, whether it comes down to a volatile uptrend or a volatile downtrend or a sideways market. I just want to be aware of the broader environment. I call this the top-down picture. Do that by looking at the moving averages in the ATR. Then I just want to be realistic and acknowledge, okay, now that I know what environment I'm in, what should my expectations be for that? If it is volatile, I'm going to go ahead and reduce my position sizes. So if I'm typically risking, 0.5% of my equity on a trade, maybe I'll reduce that down to 0.25. And I'm willing to give back open gains. I know that I'm going to get whipsawed. I just kind of embracing for that, and willing to stick to my plan and rise to the challenge, even if it is going to be frustrating. And to help me make the most of those winners, I'm going to consider profit targets and really tightening up that trailing stop when I get close to a profit target, which could either be based on a technical pattern like support and resistance, or a multiple of your stop loss. So I hope you found that helpful. Come check out the blog post below in the video, and I will add some more resources and tips in writing there to help you make the most of trading in volatile markets. Good luck.